Good morning, viewers. We'll continue with our revision kit discussion on the F3 or financial accounting. Today I'm starting with mock paper 2 of the BPP. So let's get on with the questions without necessarily spending more time on it. So the first question here is talking about IAS 37. In accordance with IAS 37 provisions, contingent liabilities and contingent assets, which of the following criteria must be present in order for a company to recognize a provision? IAS 37 speaks specifically about provisions, then contingent liabilities and contingent assets, as the name says. Now, when come to provision, there are certain conditions that we should fulfill. Then only that item will have to be considered as a provision, and then we need to recognize in our financial statements. However, if it is not recognized, those conditions, then we have to consider them as contingent liabilities or contingent assets. Now here, let's go through these conditions, what is meant in this question. There is a present obligation as a result of past events, very much pretty obvious. This is one of the very required condition for us to confirm that it's a provision. Secondly, it is probable that a transfer of economic benefits will be required to settle the obligation. Now, once you see an event or an incident leads for you to have to enforesee or foresee that there will be a future transfer of economic benefits. It's a probable. When you say probable, in terms of probability, it should be above 50% to settle the obligation. Good example is when you sell electronic items, you give warranties, and then you foresee that sometimes the customer come up for any repairs or service based on the device that you have sold, and you have already committed with the customer based on the contract or agreement or as a customer practice that this will lead into a probable transfer of economic benefits. Then that is one of the conditions that we may have to tick in our boxes before we recognize any amount as such a provision. Then the third one, a reliable estimate of the obligation can be made. Obviously, that is another requirement. We have to confirm that although we ticking the above two conditions, if we are unable to estimate the provision or the amount reliably, then we cannot consider that as a provision. Then we only need to disclose as a contingent liabilities or contingencies. So accordingly, if I choose the answers, 1, all 3 criteria must be present. Obviously, that's the answer. So we don't need to waste any more time. Your answer is the first option. Second question. Let's go to the second question. Which of the following types of error is never indicated when a trial balance is expected? Just to give a small explanation about this, when you talk about errors, there are 2 types of errors. One is errors will affect trial balance. The other one will not affect the trial balance. There are actually 5 types of errors which will not affect the trial balance. So these are errors of principle, and then errors of complete omission, errors of commission, then errors of compensation, then errors of original entry. So there are 5 types of errors. Principle, when come to accounting principle, whether you treat as a fixed asset or expense. In short, that's one good example. In detailed discussion, if you really need, please visit my YouTube channel, where I have a separate video on errors and suspense accounts. Second one is errors of complete omission. You completely omit a given transaction from books of accounts, so it will never affect your trial balance. What I meant to say, affecting and not affecting trial balance, when you see the trial balance, let's say the total here $100 and the total on the credit side also $100. Now even when the totals are matching, is in agreement, yet there are possibilities that certain errors may still persist in our accounts. So these are those errors. Third one, errors of commission, which when you are treating a given transaction in the wrong type of accounts, your classification mistakes. So that is errors of commission. And then errors of compensation, you make two mistakes, one on the positive side and on the other on the negative side, but equal amount, so it will nullify each and then it will not reflect in your trial balance. And the last one is, last but not the least though, errors of original entry. Prior to it comes into the double entry, at the time of original entry, prime entry records, when you make any mistake, that will never reflect in our trial balance. I hope it's very clear for you. Now let's go to the question. Errors of commission, obviously not. Errors of omission, here it's a bit of a clumsy. Why the wording is they are using omission, it has to be said errors of complete omission. So third one, errors of principle, it will never come. Transposition error. What is transposition error? This is what the transposition error is. For example, 2463, the bookkeeper has written 2643. And then you see between this, there is a difference. 2643 minus 2463. So there's $180 difference is coming. So this will reflect an impact to your trial balance. So my answer is actually transposition errors, but unfortunately the textbook, the BPP has chosen errors of principle. I really don't know why they have chosen that. I still believe that is not the correct answer, and I have written to them. Let me see what they are coming up with. The third one now. N company owns 55% of the ordinary shares of M company. This is something to do with consolidation. IAS 27, 28, IFRS 3, IFRS 10, IFRS 13 and IFRS 11. These are the relevant accounting standards that you have to look into when approaching such a question. But at F3 level or financial accounting level, it won't be that much complicated though. What is the correct accounting treatment? See, they have given you 55%. 55% is above our benchmark, our threshold of 51% or more, when someone can justify or establish that an investor company has majority of voting rights by more than 51%, then they can say that that investor company becomes the parent and the other company, investee company, becomes the subsidiary. Accordingly, now here, not the question of establishing it's a subsidiary. It is the question itself said that it is a subsidiary. You have to understand that it is indirectly they said it. And then now you need to understand, when preparing a consolidated profit and loss account, the condition is that if it is a parent and subsidiary on a line by line item, you will add together, and at the bottom, when you reach into profit for the year, then only we will distribute between the parent and between any non-controlling interest shareholders. This is very much how the framework is set. So I would request you to pay that attention in the right way. So now the answers. Well, the question actually, what is the correct accounting treatment of the revenues and the cost of Matic company in the consolidated statement of profit or loss of N company? The revenue and cost of M are added to the revenue and cost of N on a line by line basis. This is what I was saying. Second one, 55% of the profit after tax of M should be added. No. So this one actually only if it is an associate. Associate is IAS 28. That says that you have to do it on an equity accounting method where you only add the profits after tax. So that is not correct answer. Third one, 55% revenue and the cost added to the revenue and the cost of N company on a line by line basis. No, that again wrong. There is no such treatment. Last one, only dividend received from M company and shown in the consolidated statement of profit or loss account of M company. No, that's also not correct. So answer is the first one. So we move on to the answer question number 4. Your firm's cash book at 30 April 2018 shows a balance at bank. Your cash book, please note this. Now they may also test you or twist you by saying the balance in the bank statement. Here it is balance at the cash book 2490. Comparison with the bank statement at the same date reveals the following differences. You have unpresented check 840, bank charges not in the cash book 50, receipts not yet credited by the bank 470, dishonored check not in the cash book 140. What is the adjusted bank balance as per the cash book at 30 April 2018? What you must be doing is that you should prepare an adjusted cash book. We call it ACB. We start with balance brought forward, which is 2490, and then you have entries related to cash book are second entry, bank charges not in cash book. So we have bank charges 50, and then one more, dishonored checks not in cash book 140. So dishonored check double entry will be when the check is received, you debit the bank account and credit the customer. Once the check is dishonored, meaning it's returned, so you have to reverse the entry. So what you should do is you should credit the bank account and then debit dishonored check. Later you decide whether to debit to customer or to treat as a bad debts. That's another matter to deal with separately. On the other hand, there are other two items what they are given here. Bank charge, unpresented checks, it will straight away go to bank reconciliation statement. We don't need that now. Why? They are asking what would be the adjusted bank balance as per the cash book. So we don't need to worry about that. And they also receipts not yet credited by the bank. It is unrealized checks, unrealized deposits. Again, we don't need that in our cash book. So therefore, what we do now, we balance this. So when you balance this, our answer comes here 2300. So this is my answer, and that you need to put it in this box here. With this, I remain silent, and I'll continue doing these remaining questions in my forthcoming videos. Keep tuned on my YouTube channel. Kindly subscribe to make everyone benefit of this, and also do like and comment if you have any questions. Thank you so much.